curious, energetic. This chart shows Intel's stock price over a 12-month period, climaxing on April 24th, 2026. On that single day, shares surged 24%, the company's best trading session since 1987. It capped off an astonishing 300% run over the previous year. To understand how rare that kind of momentum is for a mega-cap tech company, we have to look back just 2 years. The market had completely written off Intel. They were widely viewed as a dying relic from the pre-AI era. The prevailing logic during the initial artificial intelligence boom was simple. The future belonged entirely to graphics processing units, GPUs, made by NVIDIA. Central processing units, the legacy chips Intel built its empire on, were supposed to become obsolete. Yet, the market's most obvious AI casualty somehow orchestrated a massive corporate comeback. Let's look at exactly how a company slated for the graveyard managed to force its way back to the center of the industry. The assumption that GPUs are the only processors required for artificial intelligence turned out to be wrong. This diagram shows the architecture of agentic AI. We've entered a new phase of AI workloads that focus on planning and orchestrating complex tasks across massive infrastructures. To do that efficiently, you need a central planner. Customers are now deploying legacy server CPUs right alongside their GPUs to manage these enormous workloads. Because of this shift, the ratio of required chips is moving rapidly back toward the CPU. Intel's data center and AI revenues have accelerated, and demand for these server chips is suddenly outpacing what the company can physically produce. To meet that demand, they had to fix their most notorious weakness, their foundries, and the data shows they are succeeding. Intel's foundry revenue rose 16% year over year, with demand for advanced chip packaging jumping from the millions into the billions. They hit a crucial technical milestone, pushing their highly anticipated 18A process node into high-volume manufacturing entirely ahead of internal schedules. By proving their legacy processors were essential to the next wave of AI and getting their broken assembly lines back on track, they created a highly attractive foundation. And that foundation drew in an astonishing amount of outside capital. First, the United States government stepped in, converting unpaid CHIPS Act funds into roughly a 10% equity stake. That single move makes the U.S. government the company's largest shareholder. It effectively insulates Intel, transforming it into a highly protected national asset. Then the competitors arrived. NVIDIA, the very company thought to be digging Intel's grave, invested $5 billion. SoftBank added another $2 billion. Corporate partnerships quickly followed. Tech giants like Google announced massive multi-year collaborations, securing Intel's Xeon processors as the host CPUs for their own sprawling AI server networks. This influx of cash and business momentum cleaned up their balance sheet. Adjusted net income climbed 156% to roughly $1.5 billion, and gross margins blew past the company's own guidance. Backed by sovereign wealth, heavily funded by competitors, and highly profitable once again, Intel secured its position as the unavoidable bedrock of global AI infrastructure. The operational turnaround is complete. Intel has stripped away its reputation as a slow-moving relic and emerged as a revitalized, fully modernized powerhouse. But a brilliantly executed corporate revival does not automatically translate into a safe stock to buy. This chart illustrates the company's valuation problem. Here is a typical tech-forward price-to-earnings ratio. Next to it is Intel, with a towering forward PE pushing into the high 80s, giving a staggering market cap of $470 billion. If we look beneath the surface of those earnings, we see the true cost of this resurrection. During the first quarter alone, Intel ran a negative $2 billion in adjusted free cash flow. That massive deficit isn't an accident. It is the mandatory, ongoing capital expenditure required to keep their new foundries running at the bleeding edge. The underlying business is genuinely strong, but investors are paying a premium that demands absolute, continuous perfection. And with heavy cash burn looming, buying in at these heights leaves almost zero margin for error.